Good evening, everyone, and welcome to the Investor's Guide to Thriving for Thursday, November 25th, 2021. As usual, tonight we'll be talking about the trends and tilts that are moving markets. And on this evening's program, Larry Berman will be joined by Mark Webster, Director of ETFs at BMO ETFs, and they'll be discussing one of the biggest movements in investing, which is the shift to environmental social governance factors, or ESG, when evaluating investments. Among other things, they'll discuss whether ESG comes at the expense of lower returns for the greater good, or if ESG factors can, in fact, help identify companies that are poised to generate elevated and sustainable performance. But before we get on with the show, I'd like to take a minute to acknowledge the sponsors and supporters of the Investor's Guide to Thriving, which are, of course, BMO Exchange Traded Funds, who have been our partners in ETF education since 2009. And our group of companies, which includes ETF Capital Management, where Larry manages ETFs and funds of ETFs in partnership with BMO. We also work directly with clients on portfolios of $1 million plus. You can learn more at etfcm.com. Q Wealth Partners is the fintech and portfolio management platform which powers ETF Capital Management and our rapidly growing network of partner offices across the country to deliver the next level of client experience. Q Wealth is now coast to coast and growing at a rate of about one office per month. So for all those investment advisors on the program tonight, if you'd like to stop working for an investment dealer and start owning your practice and acting as a true fiduciary to your clients, please be sure to visit qwealth.com to learn more. Lastly, but perhaps most important, Investor's Guide to Thriving is brought to you in support of the research efforts at Sick Kids to find better cures for childhood leukemia, and the Baycrest Foundation, where we support their world-leading Alzheimer's and dementia research efforts. If you'd like us to match your donations, please use the links in the survey you'll receive after the event or visit investorsguidetothriving.com and use the links there. This is how we'll be able to track and match your generosity. Well, that about wraps up the housekeeping segment of tonight's broadcast, so I'll turn it over to the smart people in the room. Larry and Mark, over to you.
Well, thanks very much, Jared, and I'll invite Mark to come on here. I would read through Mark's resume, except it's long and extensive. Mark and I go back many years. When I go out to Western Canada, where he heads the ETF distribution team, we would spend many days and hours on the road together and have some great conversations. And so maybe some of those will come up tonight, Mark. We'll tell the folks a little bit about some of our not so public conversations, and maybe not. Depends how much trouble we want to get into, I guess. So anyways, folks, tonight, a couple disclosures for you. One, I've had a really bad week in terms of sciatica, and if I stand up from time to time, it's because I'm getting a sciatic pain down in my legs. So I just wanted to say that up front. It's been a tough week that way. And two, if all goes well, sometime in the next 24 hours, yours truly is going to be a grandpa. So pretty exciting time for me here, and I'm on pins and needles a little bit. So if I get a little wonky tonight, you'll know why. And so, Mark, welcome to the show.
Well, thank you very much for having me.
Okay, so getting right into today's agenda, it's all about ESG. And Mark, I think you're one of the experts in Canada in this area. You spent a lot of time in recent years studying, reading papers. There's not a month that goes by that you're not flipping me some kind of, you got to read this kind of a report. So I think we're all going to benefit tonight from our conversation about why you should care about this area of research. To date, it hasn't moved the needle much, but I think we're at the point now where it's really going to start. And there's a couple talking points tonight I think you'll really get something out of. And then, how do you participate? How do you play? And this is not designed to be a BMO only webinar, even though Mark's from BMO Global Asset Management. But BMO is Canada's leader and one of the world leaders in these areas, and so quite proud to have them on, in addition to being a great sponsor partner. So again, thanks again, Mark, and let's get right into a little bit of the history of this whole area of responsible investing. Can you take us through a little bit of the history?
Yeah, thank you very much. If we think of how this all started back in the 1920s, Quakers in the United States made the decision that they would not invest in companies that didn't share their worldviews. And so they made a deliberate decision to exclude certain companies from their investment portfolios. In the 1930s, this became a little bit more pronounced. The notion of companies being good corporate citizens was formed in the 1930s during the Great Depression. For those of us who are, sort of Larry's, well, I guess I'm a little older than you, Larry, but if you remember the hippie movement, there was definitely an ecological vein to the hippie movement. And we came up with socially responsible investing in the late 20th century. This really became a little bit more codified when the UN Principles for Responsible Investing referred to ESG as being a fiduciary concept. And that's something we can talk about a little bit more about. When you decide how to incorporate responsible investing or ESG into your portfolio, there are a couple of things that you have to take into account. Most of this focus is on what do you own or what do you avoid owning, and these have really become a huge part of everybody's decisions. I mean, how much in stocks, how much in bonds, what do I need in yield, what's tax effective? The other thing that's now being incorporated into people's decision making is what time am I having a positive impact when I allocate my capital? Is it possible for me to cleanse my capital? And really, that's that notion of cleansing capital that's at the core of all of this.
It's quite interesting. A couple of weeks ago, COP26, it's clear from a world leader government standpoint, they can't all agree. They know they need to be there. The speed of this whole ESG movement. Now, obviously, the environment is the focus of COP, but there's so many other areas. I think, and I really strongly believe, that we need corporate citizens. We need corporations to get us to this zero emissions. And I think investors need to get on board here into thinking about investing from this perspective. I think it's new to a lot of people. It hasn't moved the needle in years, and it's really just not about, as some governments would position, we've got to get off carbon, right? It's not just about carbon. There's so many areas here. So can you take us through the three areas and maybe drill a little bit deep and give us some meat around these?
So you're absolutely right, Larry. There's this notion that investors have to allocate their capital responsibly. If you think about what we're trying to accomplish, we want to make sure that when we allocate our capital, that we don't give money to companies that have controversial business practices that could impair our capital. And that's really why ESG has become a focus. Generally speaking, ESG will not exclude sectors or industries. It'll weight towards those companies in those industries or sectors that outperform their peers, that have higher rankings. And so this really is a measuring tool to isolate which companies deserve more capital than their peers. And you're absolutely right. The focus has been generally on the environment, where the most vocal debates have occurred. But we've seen through Facebook whistleblowers, through some of the things I love to sort of throw up. If we harken back to the early part of the millennium, Enron's disappearance, the company totally disappeared because of a failure in governance. That's a really dramatic. Often we talk about companies seeing their share price drop. I mean, this is a company totally disappeared.
Well, so I was at CIBC at the time, and I know this because I know, and we paid a big fine for this. CIBC investment banking in the U.S. was behind Enron and hiding this stuff, like creating these structures off book, and they think they're doing a good service here. I remember we had to write, every employee had to write these online exams about learning how to be a whistleblower and telling when you saw something that they weren't supposed to be doing. You know, it was really quite something.
So Enron disappeared. Arthur Anderson, their auditor, also disappeared. So I mean, these when you say what you're trying to do is avoid controversial outcomes, well, I can't think of a better example.
No, absolutely. You know, first question comes in today, and obviously I knew it'd be oil and gas, but the whole push this way, you know, has caused unintended consequences. So in these areas, are there unintended consequences? Like obviously in oil and gas, there's been a lot of disinvestment, right? You know, you've heard companies for years, we're not reinvesting in CapEx and finding new oil wells and gas supplies because we know it's a diminishing curve. And there's a lot of chatter now that that's behind some of the spike in oil prices.
So there are a couple of things that are happening all together. So one great example is January or February 2020, the Harvard Faculty of Arts and Sciences held a vote, and the professors, and a majority, decided they would like to divest from fossil carbon. And they submitted this to the Harvard Investment Committee. And the Harvard Investment Committee is a fiduciary. It is incumbent on them to hit target rates of return to meet their liabilities. And they thanked the Faculty of Arts and Sciences very much. They would take that under advisement, and it was put on the corner of a desk and nothing changed. But you can see that an awful lot of fiduciaries are being pressured to exclude, to take very, very stark decisions on what should and shouldn't be in an investment portfolio. We are in a transition economy. I'm speaking to you from Vancouver, where we have gas rationing because one of the pipelines was damaged, and you can't drive into a gas station. There's the sense that everybody's got to have a full tank has made people who otherwise might have had different opinions about energy line up like everybody else. The notion that we can all drive electric cars lickety split is unfortunately not possible. It'll take roughly a dozen years, if we were all to start today, to flip over the world's fleet of personal vehicles, because we have so many cars in different countries around the globe. You and I, Larry, can buy an electric car. There are some cities in China that use 100% electric public transport, but their electricity is fueled by coal. And so, on the one hand, you're not burning gasoline, but your fuel source is still a very deep fossil carbon footprint. So this is a transition that'll take several decades. There is also the notion, and you alluded to it, of a stranded asset, meaning if you apply your capital to an area that will be marginalized as renewables and alternatives become more scalable, you'll eventually pay a capital cost. And so there's a desire both on the part of individuals, but sometimes a little bit on corporations, where companies where they will not invest in the CapEx. So this will take a long time. The other thing to consider, the UN has its principles for responsible investing, but they also have designated Sustainable Development Goals, which companies have signed on, countries have signed on to. There's 17 of them, but I mean, if you enumerate eliminate poverty, access to clean water, to medical care, to education, to a meaningful job that can give you a living wage. If we were to get rid of fossil carbon fuels, a lot of developing companies countries could not get their goods to market, and they would never be able to meet these very admirable, desirable, sustainable development goals. So this is a very difficult way to make progress, and that's why ESG is there, not to exclude, but only to pick out the better representatives amongst
the champions. I think on a go forward basis, the champions here are going to do better for lots of different reasons. I wonder, in terms of corporate governance, if share buybacks as an idea. A company makes money, so what do they do with it? They can pay their employees more. That's kind of against the profitability model. They can boost dividends. They can invest in plant and equipment, or they can buy back their shares and boost the compensation of the executive management team. I wonder if that's not going to become part of corporate governance.
So remuneration, and of course share buybacks are interesting because an awful lot of senior executives are rewarded for improving financial ratios. One of the ways to interfere with the valuations is to buy back shares. So yes, that the notion of remuneration is a big focal point for the governance part of the ESG.
Yeah, what we've just started to see in maybe the last year or two during earnings reports are where companies are actually talking about, here's our ESG ranking, and we're starting to get very proud of this, and we're good corporate citizens, and they're actually seeing some benefits, which we'll get into. So let's look at the penalty side of things. When a company does a bad thing, they're getting punished. There's a couple of slides here where there's some examples. Want to talk about voting with your wallet is another from a negative standpoint here?
So these are great examples. Some of us may remember, some of your older audience members may remember when the Exxon Valdez spilled copious amounts of oil off the Alaskan Panhandle. And there was only a bare ripple when that happened, and I think it was 1987. The stock had a little bit of a quake, but nothing significant. TEPCO, which you have up on the screen, is the Fukushima nuclear disaster. Again, so it's an environmental issue. Unfortunate, Valiant, you have to have a Canadian example up there. That's a governance issue. Volkswagen deliberately posting fraudulent fuel ratings. That's governance. Equifax and their data breach, well, that's governance as well. And so these are just examples that there is a price to pay if a company has controversial business practices. And if those are left unaddressed, quite simply, your risk budget is higher. And that's why using an ESG overlay people often refer to ESG as being level 1 risk management. The funny part is, in the past, this was tucked away in company footnotes, contingent liabilities. Putting money aside for potential cleanups of oil wells or mining.
PG&E.
That's right.
PG&E, yeah.
But now these regulators around the world are now mandating that this information has to be disclosed in an ESG report. And so this is becoming front and center. We did a session earlier this week, which airs on the 1st of December. and it's called ESG, the financial ratios of the future. So this is very much becoming a core financial consideration for investors, regardless of size.
So as we filter for quality, clean balance sheets, good earnings ratios, ESG is just going to become another of that mainstream kind of thing we filter for and say, you know
Right.
what, the bottom half of companies, okay, you guys aren't cutting the mustard. So I think this is a good way to get us, you know, not just on the environment side, but overall improve the anger with Wall Street, all these kind of items that have come up from time to time. So, you know, so the financial benefits. So a recent survey was done here, and I guess Canadians, but just investors in general, believe that, you know, on the return side, like, is this something that is going to stick? Is this a fad?
Well, so there are a couple of ways to look at this. So as I mentioned, ESG is a risk management concept. So is there a financial benefit? The minute there's a risk management overlay, yes, there's immediately a benefit. There's a correlation, a positive correlation there. Both Deloitte's and Price Waterhouse's consulting arms have done studies, and they've shown that by 2025, over 50% in one study, over 60% in another, of the North American asset management industry will be managed according to some kind of responsible engagement or investment overlay. That's significant because the North American asset industry is the largest in the world. This has already started in Europe. It's starting in parts of Asia, but it's really taking root here in North America. So this is starting to become, I don't like the term, but it's something that people refer to as table stakes. If you're an asset manager, you had better be seen to be doing the right thing to incorporate ESG into your investment process. The other element to consider is that Canadians of all generations are interested. The numbers, not surprisingly, are highest amongst the people who are going to inherit a lot of money in the coming years. And so as their voices get louder and louder, they'll make more and more demands for transparency in the way their assets are managed.
I asked my my youngest daughter, and I said, would investing in an we're launching an ESG fund next year for Q Wealth Partners. I asked him, would you be okay with a slightly lower return if we incorporated ESG as a factor? And I wanted to hear her response, and she said, yeah, I think so, right? I didn't talk about magnitude. I said, well, how about if it was a slightly better return? She goes, oh, that would be great, right? You know, in terms of best of both worlds, not only can we make an impact with our savings, but we can also maybe do a little bit better with our savings. So historically, it was thought of as you had to give something up to do this. And my view, I'll tell you, 5 or 10 years ago, Mark, when someone asked me about it, is, listen, I don't want to exclude anything. I mean, if oil and gas is going to lead, then I want to put money in oil and gas. So now the question is, okay, who are the best oil and gas companies, right? Because, you know, Chevron in the US is ranked as the #1 oil and gas company. If you look at all of them that play in that space by way of ESG. Now, if Chevron wants to be the energy company of 20, 30, 40, 50 years from now, it's not going to be based on getting carbon out of the ground to the consumer, right? It's got to be something different.
So this comes very much back to the notion of do you exclude or not exclude? And you know, it's really interesting. If you exclude, and I got to say right off the top, you can't exclude. The notion that you can exclude something you are going to get vicarious exposure to it somewhere. I mean, you want to exclude conventional energy, oil and gas. That means you're probably not going to buy a steel producer because you're going to get vicarious exposure there. You're not going to you're not going to buy a rubber manufacturer, a railway. I mean, so it's impossible to exclude. The other thing is, if you exclude, you can't be an activist investor. You can't either engage with management or vote against management in proxy voting. And so it's a heavy, blunt instrument. It's not terribly practical, and you may actually be doing a disservice. A lot of oil companies have patents for alternative energies or renewable energies, and they have the capital to make those patents commercially viable. So
they are. They're actually, yeah. Some of the biggest investors globally in green energy are the oil and gas companies. I look at, yeah, they have to. I look at Saudi Aramco being the biggest oil play in the world. There's a reason they put themselves up for sale, and they continue to want to sell more. They know that the assets that Saudi Arabia has, whether it's 10 years or 50 years or 100 years, isn't going to be the same market once renewables are really the core part of how we move around, certainly from a transportation standpoint.
12 years ago, I participated in a green private equity conference here in Vancouver, and one of the largest contingents was from Saudi Arabia, and they were looking at what small private equity green initiatives were going on here, and they were looking to invest.
Yeah, I think from a government control standpoint, you got to do things so that you don't hurt the current. What's going on now. It's too radical in some cases, but the more extreme view in terms of the environment tends to be a bit more radical. And frankly, I think they're right in many cases. I was reading an article that, from back in 1990, where it was the exact same headline as today. If we don't do this in the next 10 years, it's a catastrophic ending to the world, right? That was in 1990, those things were being written. And so, 30 years later, the world hasn't ended. And so how do we know today, 10 years from now, so you've got the more extreme views of things for decades now have been, trying to shake the foundation. But I go back to Chevron. I believe Chevron was the company who bought the original EV and buried it, if I'm not mistaken, right, to protect. Yeah.
But,
so
it's unfortunate that it took so long for activist shareholders to have an impact. But look what happened at Exxon in the recent voting sessions. People assigned board members. Changes here.
Yeah, I agree. So speaking of change, so we're starting to see a difference when we look at, so we have two indexes here. One of them is the index based on the BMO ETF, which is a Canadian dollar-based global ESG leaders index. And this is developed markets, so no emerging markets in this index. And I'm comparing it to the MSCI World in Canadian dollars, and you can see they track, pretty much identical. But it's only in the last year or two where we're just starting to see a difference when you take an index and you factor it for ESG and you increase the weighting in companies that are better at ESG.
So these are achingly close, and it almost appears for most of this that one overlays the other. The differences are trifling, and I think you alluded to this. Is there a price to pay for cleansing your capital? And if you're fully representative of the economic data set, because you don't exclude industries, you exclude companies, but you don't exclude industries, your tracking error can be minimized. And that's why you get this, call it an overlay, in where returns are so similar, it's not worth discussing. I'll have a little bit of fun with you, Larry. For part of this period, oil in particular has done poorly. And so the ESG index has outperformed. We've seen in the last few months that oil has improved. So you may see the white line overtake the, depending how long the energy prices stay high, you may see the white line overtake the orange line. But when oil drops, expect that to revert to the pattern that you have here.
Yeah. So that's a bit of a factor. That's a bit of a factor for sure, and that's one of the obvious ones. But aren't a lot of these indexes structured where they're trying to keep a similar weighting to what the other, like the traditional indexes are? So they're not just excluding energy, or someone was asking, is there an index or an ETF that doesn't have gun manufacturers in it, right? So there's everybody's got these areas that they would like to avoid.
Now, I don't want to dwell into what we did, because this is meant to be educational and not to promote anything, but we had some pretty distinct discussions internally. We got very animated with one another. We did a due diligence that, I kid you not, lasted probably 3.5 years before we picked this index. And we picked it because it doesn't exclude. The rules are very, very simple. It has the same sector weights as the parent index from which it's taken. So this is from a sector perspective, it's a carbon copy. It doesn't exclude sectors, but it excludes companies where they earn an appreciable part of their income from weapons, non-conventional energy. So you can think of offshore drilling. I'm going to call them tar sands, because only Canada calls them the oil sands. The rest of the world calls them tar sands. Thermal coal, out. Nuclear, out. Gambling, tobacco, out. So a company like Louis Vuitton, I always mess this up, Larry. LVMH. So the LV, we know. The MH is Moet Hennessy.
Moet Hennessy. Yeah.
They are not in the index because they sell way more alcohol than they sell leather goods. And so because alcohol is such a large component in LVMH, they don't make the criteria. They don't make the grade, and that's so it's very, very interesting. So what we like, and I used the term already, this index captures the data set of the underlying economy, but it's best in class. You either make the grade or you don't make the grade, and if you don't make the grade, you're not included. And over time, you know, as you see in this little graphic you stuck out, it gets rid of what we call the laggards. So the leaders index is companies that are AAA and AA rated. You don't have the companies with really severe controversy scores, the B's and the C's, that could end up in a portfolio and potentially impair your capital.
So, but MSCI is not the only one that does this. There's probably several dozen, but MSCI is a well-known global index provider.
So we picked MSCI. There are two parts to this equation. So one of them is, do you have the capabilities to measure, rate, and then rank? So you want somebody to be able to go and measure all the companies within a subsector. They do their company analysis, so company A versus company B, at what they refer to as the sub-industry sector. They identify 158 sub-industries. You can't compare a bank to an oil company to an agricultural company. There's no commonality in their business models. So instead, they're very, very specific, comparing like to like. Even in energy, drilling companies are compared to drilling companies. Refiners are compared to refiners, and you know, they've got 250 people who just do the measuring, ranking, and rating. But
I had heard that, yes.
Yeah, and they take over 1,000 data points in their ESG score. I mean, it's insane. You know, you use the term, and it's flattering, but you said, you know, Mark's an ESG expert. I don't believe anybody can be an ESG expert. We can be very well versed in a small part of this, but there's no way anybody has the breadth of knowledge to be able to be conversant across ES and G. It's just not possible. Right. And that's why relying on these firms, MSCI is not the only one. S&P Dow Jones does it. FTSE Russell does it. There are a host of others that do it. What we liked about MSCI is that these are institutional benchmark index providers. So they pair the top of the class screening mechanism with the ability to incorporate that and build very liquid investable indices. That's an important consideration.
Right. A couple of years ago, I was at an ETF conference in Florida, and hope to start going back to them live again in the springtime or in the wintertime this year. Came across an ETF that was launched a few years ago in the US, a firm called Just Capital, which was one of the original founders and guys who got it going was a hedge fund manager named Paul Tudor Jones, and he was at the conference. He's very famous for calling the market crash in 1987. There's some YouTube videos out there if you want to see who he is. But so these guys do exactly what you say. They break it down by these sub-industry sectors, and they say, you know, which companies are the Cadillacs of their areas. So Target, they have ranked as the best retailer in the US, and they would go through their version of ESG rankings and so forth. So, you know, a lot of the technology companies overall come to the top because they're cloud, they're green, not a big use of energy perhaps. A lot of them are woke, if we can use that word, where they're very progressive in terms of wanting to be green and have been leaders for a long time. So you see a lot of them overall, but you know, even within some of these sectors, you find you know, who are the leaders are, and the index then is made up of the best of the best. So they're all trying to accomplish a very similar way. They all have slightly different ways of rating the companies. What I'm going to do for my fund is I love MSCI. I really like what Just is doing. They go sign up for their emails, by the way, very, very enlightening. And then S&P Global, right? So you've got these major index providers. They're all doing their filters. And I'm going to check these companies that we want to own with all three of them, because I'm never going to have the capacity to do the work needed to come up with a viable ranking for these companies. I don't know how anyone could do that, actually. As you said,
Larry,
to be an expert.
For you know, Larry, you've been in capital markets for decades, and for someone like you to show that humility and say, I can't be expert, I have to rely on outside sources. You know, we license the MSCI index capabilities for ESG, but we're also part and parcel of a host of industry groups for two reasons. One of them is we want their information, but we also want to be able to influence them. And so we also use many different inputs when it comes to exactly what you've put up here, which is, it's one thing to talk about what you own, but it's another thing to ask is, what's the stewardship discipline, and does this represent the aspirations in your capital? And so it's I referred to the UN principles of responsible investing, and there are about 4,500 companies, entities that have become signatories. Over 3,000 of those are asset managers. 50% of those asset managers have signed in the last 2 years. And there's a great sort of, I suppose, skepticism that in most of those instances, people have signed on for marketing reasons rather than having fundamentally changed their investment approaches. The easiest way to do a litmus test to see whether an asset manager is fulfilling their promises is to check how they engage with management and how they vote in proxies. I'm not going to be rude and name drop, tempting though it may be. You would be surprised at the track history of some of the world's largest asset managers when it comes to voting against management. Either they abstain or they vote with management to an alarming degree, not exercising the stewardship responsibilities they have when they're managing somebody else's money. We've been exemplary in this area.
Okay, so someone's challenging you here, Mark, with a question. Where is BMO ranked regarding ESG within the banking community? Is there a ranking of good corporate citizens?
So you wouldn't rank us. So that has not happened yet. That is about to happen, where we will start ranking banks. If you rate us as an asset manager instead of as a bank, so I'd like to give an illustration that's serviceable. When you sign on as a UN PRI signatory, you've got to submit a report, and that report is graded. So it's an annual report. It takes a lot of time and energy to fill it out. We have been ranked since we've been doing this for a couple of decades. Well, it was 2006. So we've been doing these things for quite a while. We are ranked an A+. Now, if you get out of law school or an engineering degree and you go for a job interview, you say you got an A+, you're hired. So we've done very, very well. But that's where I think you're going to see this distinction between those 3,000 plus asset managers who've signed on recently, as their reports get graded and issued, and these are all public knowledge. You can go on to the UNPRI website, check out an asset manager, see how they're graded. You'll see that we still have that A+ rating. So we've done very, very well. We've fulfilled the promise that the exposure imbues in investors.
This whole notion of greenwashing, the Ontario securities regulators had a webinar a couple months ago that I watched, and they had some ESG providers, some asset managers, and some regulators, and they were all having this panel conversation. And this greenwashing for marketing purposes was a big issue. I'm telling you right now, I'm not going to be an activist. You know, I'm not going to engage with management. That's not my skill set as an asset manager. But utilizing the rankings and saying, hey, these are the better companies to invest in across a breadth of industries and whatever. I mean, you know, is that greenwashing, or do I have to actually be an activist investor?
So you don't, and you know, there's a distinction to be made, Larry. You're not a UNPRI signatory, and if you're going to be using ETFs, the asset manager will be doing that engagement and proxy voting on your behalf. If you hold individual company shares, your voting shares would be so minute that you wouldn't be able to really affect change on your own. As an asset manager, we're still a little bit bigger than you. I know you're growing quickly, but we're a little bit bigger than you. So we have been able to make a little bit of a difference. You know, greenwashing initially was made for consumer products, and now we refer to greenwashing when it comes to asset managers who seem to have become green or ESG or responsible investing focused, there's a term that's come out as green wishing, where you say that you've now changed what you do, but there's no quantifiable data to show that your process is any different than it was before you became a signatory. And these are the things that will get flushed out in those report cards in years to come.
Right. A lot of the big asset managers in the world, the sovereign wealth funds, they're all moving pretty heavily. One of the foundations that I sit on the board, Children's Aid Foundation of Canada, we have our due diligence conversations, our fiduciary talks, and we say, do we need to start doing this now, where we're an advocacy group for youth in trouble? How could we possibly invest in a company that uses kids as labor, right? And we now have to tell all our asset managers that are running our portfolios to exclude all the bottom half of companies that don't do that. And I think we're going to just see more and more of that.
It's becoming a core. Nobody wants. So when you're on a foundation, their own governments, their demands that they don't want a public relations scandal. If you're a pension plan, you don't want it. A great example, I was at an institutional conference and people were chatting over coffee, and the subject of private prisons in the United States came up. From a cash flow perspective, these are great investments. They are not acceptable. Yeah. And so a few of the two of the people there from different pension plans mentioned this is how important it is.
So let's look at some of these things that people ask about. Is it a fad? Is this a passing trend? I don't think so. I think a lot of our conversation tonight, speaks to the fact that no, this is real. It's not a passing fad. It's not the trade of the day. This is going to grow and grow and grow. And one of the reasons why I wanted to do this conversation tonight is to bring that awareness to people that may not be thinking about it that way, and how important this line of thinking is going to be and going to get down the road.
Yeah, so we've touched on a number of these. The notion that ESG is in essence recognized as a fiduciary obligation. So as an asset manager, if you think about it in the most broad, where you're managing somebody else's money, it's incumbent on you to take ESG into account in your investment process. The other element, the only one I would, if you can just go back one slide, Larry, you had a little bubble that asked, is responsible investment ethical investment? There is this notion of outcomes, wanting to drive a desirable or specified outcome, and that can be, some people have the thou shalt nots. I don't want tobacco, I don't want nuclear, I don't want fossil carbon, those types of things. There is a slight difference. Now with ESG, people are asking the question, I'm not excluding sectors or industries, but am I making a difference? And now people are starting to measure. In fact, we were at the top of the pack. I think you have a slide later on which shows that you can measure the degree to which we cleanse your capital with these special indexes.
So we talk about excluding all these areas. I like a good martini after a tough week, I'll tell you that, but smoking's not for me. But these things, it's come from being exclusionary. And again, I think it's you got to start thinking about it. Well, what do we include more of? as opposed to the other way around. I think the exclusion part of the thinking is more extreme. How do you get from here to there? And so if I was running Canada, I would want to invest more in growing nuclear, because that's a way, I think, for a large scale transition away from carbon, but to more electricity source. So I think you got to think about the path, right? As opposed to, let's just not do this. But when you look at the economic model says tax more of what you don't want and tax less of what you want more of. So carbon taxes are kind of come into this too, I guess. But so I really think the inclusionary part is what we want to get people to focus on.
Well, yeah, I already mentioned that you're going to get vicarious exposure to something somewhere. A lot of people say banks, as an example, have fueled, pardon me, bad term, have financed fossil carbon creation and whatnot. Before anybody comes to a bank for money for a loan for capital, they've got to have insurance coverage. There's just an example. So every energy project has to have liability coverage. They may self-insure, but you can be sure that they'll, through the back door, they'll get reinsurance to cover their own liability or their own risks. So you can't fully exclude. As mentioned, if you don't buy, then you can't engage management or vote against them, and it does make a difference over time. Our responsible investing team that does the engagement and voting is regularly asked, how can we work to improve our ESG scores? It's a two-way street, and that engagement, if you don't have that at all, you are not making the biggest positive impact possible.
So when it talks about, when we get into sort of index creation and how do you build a portfolio here, there's a process here on the screen where MSCI would start with a big universe, and I guess they're applying different filters along the way to come up to the best. Can you take us through a little bit of this, how it gets done here?
So there are several screens. So the way to make it into the index, they take the top ranked companies in each subsector. So they will immediately do ESG scores to distinguish two oil drilling companies, two soft drink companies. They'll compare them cheek to cheek to see which one has the better score. So if you've got a low ESG score, you're marginalized right away. The other thing is to ask, you may have what we consider to be a good ESG score, but you may have controversies in your business. So you mentioned technology, Larry, a great example, and you've got the Canadian index up here, but I think by far the most telling company would be Facebook in the US ESG leaders. Over a year ago, MSCI excluded Facebook from its rankings, and the reason was when it came to its policies with its employees, they pay well, they have flexible hours, they have good working conditions. There are a lot of things they do very, very well. But when it came to the algorithms they use to promote advertising to their users, they had pretty bad scores. And so there was a great example well before the whistleblower events that happened just a few weeks ago. They were removed from the index because they had controversial business practices, which could at some point potentially impair people's capital. And the last bit is they will look, if the two companies have the same ESG score, but one has an ascending or rising score and another one is static, they will pick the company with an ascending score. If two companies have the same score and they're both rising, then they'll pick the company with the larger market capitalization, because again, they want this to be the most representative of the underlying or the parent index. So all of these screens are there to make sure that the best possible constituents, best in class, are involved, but also that the leaders index is a very good mirror on the opportunity set, so that you aren't giving up potential return in future years.
Someone was asking about cryptocurrencies, and I'm not sure MSCI ranks them, but there has been said that they are our big energy pigs, for lack of a better way to explain it. They're not carbon friendly. I saw a whole webinar on why they're actually more carbon friendly. It's just amazing the propaganda that is involved in pushing, I'd say the largest bubble of maybe our generation since tulips.
So Larry, I think I'm really glad somebody brought that up, because this is a push-pull subject. When cryptocurrencies take more energy than Ireland, there's an issue, and we can say whether it's cleaner or it's not cleaner. That depends where you are. In some areas it'll be coal, in some places it'll be hydroelectricity, but nonetheless, its energy footprint or demand is enormous. On the other hand, if you live in a country with a repressive regime and you want the ability to move your capital around, well, Bitcoin or Ethereum, some kind of cryptocurrency, may have very good social considerations. And so I think this is a great case of how do you evaluate something? How many different criteria do you have to appreciate before you can properly or adequately score cryptocurrency? It's not easy, and this is why you have to use somebody else, a rating agency, to do this for you. It's not easy. It's not cut and dried.
So the question came up here. These are examples of companies that were removed from the indexes at different phases or included. Looks
Excluded.
Like excluded, yeah.
They're removed. Yeah.
Yeah. And I should say BCE, parent company of BNN. Yeah. They always like us to say that.
Sorry about that.
Yeah, no, it is what it is. The question came up. Happy to field it. So when we're looking at these indexes again, because it's important to understand what we're building here, and when we're emphasizing some companies more over others, the ranking of these ESG scores compared to the benchmark. So they're showing the environmental score overall for the broad MSCI World Index is a 6.1. I presume it's out of a 10 score. And so the environmental score of the better companies are 6.7. Social score being 5 is neutral, 5.4. Governance 4.9, 5.2. So, you know, it's kind of the top half. Is that the way to think about it?
You're certainly getting you're certainly getting 50% of the market capitalization of the parent index, and the 50% will be those companies that score better than their peers. So the people in the top 50% score better than the people in the bottom 50% that's been left out. And you can see in the bar charts where the parent index has companies in B and triple C, whereas you don't have any in B or triple C in the leaders index. And that's this filtering process, saying, okay, those companies whose scores were deemed to be laggards are totally missing from the from the leaders index, and you can see the overall ranking goes from an A to a double A. And the only reason the A and the triple B, and there's a very small allocation to double Bs, the only reason those companies are in there is to meet that 50% capitalization requirement, so that the data set or the opportunity set matches that of the parent.
So conceivably 5 years, 10 years from now, more and more companies focus on this. We're going to see higher overall rankings for everybody, right?
You will, but as everybody gets better and better, you will
Relative.
still see. That's right.
Still the
This
top
becomes
half, right?
This is Einstein's relativity game. That's right.
Right. So this really can move the needle in terms of getting from A to B quite quicker on all sorts of areas, improving corporate governance, social, and of course the environment being a big standpoint. Mark, when you showed me this slide, my chin hit the floor, because you're talking in colors, and someone asked a question, how do you make us the Warren, I want you to make me the Warren Buffett, right? So thanks for tuning in every week. I'm not sure I'm going to turn anybody into Warren Buffett here, but when you look at the profitability of a company, the cost of capital is a big factor. And so what this graphic is showing is that people with the best ESG scores have the lowest cost of capital, whether it's their debt or their equity. This slide alone tonight tells you that there's something here. And the market, from a total return perspective over history, hasn't rewarded it even nearly enough yet.
So you touched on it before when you had your overlay of the world index versus the world ESG, and there was that very slight outperformance. But as you can see, and this is it in a nutshell. This might be the most valuable slide in the entire presentation. If you can compound this lower cost of capital over time, it's a self-fulfilling prophecy. And so I used the term before, stranded asset. The reason this is so pronounced is that if we take primary industries, resource companies, where their water policies, their cleanup, all kinds of the contingent liabilities that they may have, those lead to higher costs of capital. Because capital could be impaired, because the asset could become stranded at some point. So this is a very, very telling slide.
Indeed, I again, if you take nothing else out of tonight, understand that companies who are doing it better by way of ESG factor are paying less for their debt and are able to get a higher multiple in terms of their equity. And I think that is a big message here. So, take us through this slide here in terms of what are we looking at here?
So this is taken from, we do a report card, we call it, it's done every quarter, it's called the Bank of Montreal ETF ESG report card. And this is where we provide the same transparency that we do on holdings to the way those holdings measure. And as I mentioned, people have gravitated towards ESG rather than excluding industries or sectors. But people still want that measurement element. And this is where we've been the first of our kind to give this amount of disclosure. So top left-hand corner, you see the carbon risk is 42% less by using this ESG leaders overlay to screen the companies. Most people would be very happy to see that their carbon contribution has been shrunk by 40%. That's a considerable number in an economy that's still in transition. Reputational risk, you can see virtually none. Governance scores are better. The risk metrics, and I think this is really, really important, because where your risk is in line with the broad index, it will act very, very similarly. So you can see there's a little bit of tracking error, and you expect that because it's screening things out. Turnover is interesting. I always chastise people for using the word passive. Here's a great indication. This is an index, but the ESG Leaders Index has 5 times higher turnover. Why? Well, because some companies have rising ESG scores. They will earn more higher proportion in an index. Some companies may have changes in their capitalization range. They may get added, they may get deleted. So there's a fair amount of refresh in this. It's very akin to what you would see in some buy and hold active portfolios. Standard deviations, very similar, but slightly less on the ESG. And the Sharpe ratio, which is a risk-adjusted return measure, you can see very much in line, but just a little bit above. And those 2 basis points may not seem significant, but that's accomplished on a 10-year figure. So very, 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 very similar to what I keep referring to as the economic opportunity set. And you see performance, and you can see that they're very much in line with one another. You do not have to give up return potential when you cleanse your capital.
Right. So I think that, for a lot of people, this line of looking at things, but I do think that spread between the generic index, the size of company index, and the ESG filter, you're going to start to see more and more. A long period of time now hasn't been a meaningful difference, but as I showed on that chart, the last year or two, it's starting to just a little bit every year, and I think that little bit every year is just going to keep growing bit by bit by bit as more and more focus comes into this lens.
And I'm glad you put this slide in, because you had the other one which showed the lower cost of capital. So already high ESG companies have a numeric advantage when it comes to their financial ratios. So they're paying less for their support. What's really interesting is if you look at ESG or responsible investment indexes, and you see the way their weighting changes because they are outperforming their peers within a sector or an industry group, you see they get a lot more coverage, and over time they will start to attract more capital. And so here's just an example of the Canadian ESG leaders against the S&P TSX weights, and you can see that in most instances they're over 200% greater exposure over time. So you would expect, it's a natural inclination, capital will gravitate to those better companies over time.
When we dig a little bit deeper into the index return, so again, I'm comparing the ESG Leaders Canada ETF. Again, it's only been out since early 2020 against the broad TSX Composite. So that's the relationship we were looking at before. And so you can see the ESG number has been bigger. If we look at the weight and the dividend, so you can see that the dividend is slightly higher, but pretty insignificant, 2.89 versus 2.81 for the broad TSX. When we look at the sector weightings, you can see, some are higher, some are lower. Financials are still a big number there. But the energy sector is still 10% of the index. It's not like we're excluding energy, but it's a little bit lower. It's a little bit lower there. And this is during a period where energies shot the lights out, coming off the lows of the depths of last year, for sure. Now, to what extent is the incredible return in Shopify that's in this index, responsible for that? It's a big company, big index. That could explain a lot of the difference.
You mentioned before technology tends to rank quite well. Now, of course, we do compare technology companies against one another. The technology exposure should be pretty similar, but obviously we've seen from a performance perspective, the pandemic has really powered technology companies. Shopify, to all intents and purposes, is a technology company. The performance, when you can do an attribution on this, and you can say, yes, I mean, this has happened, maybe not because of screening, but just because one sector in particular has done terribly well in the last 20 months.
Yeah. So to what extent then is if one stock in the TSX, Shopify is the biggest, but to how big does this do these index get capped at a certain percentage? Is there, what are some of the rules around those?
So the rules really follow what they're trying to accomplish on the parent. So as long as Shopify, so Shopify's weighting here has nothing to do with its size in the Canadian market. Shopify's predominance in the leaders index is based on its ESG and its capitalization. So it probably has a similar score to somebody else, but its market capitalization is bigger. And so that's why it would have a bigger space than one of its rivals,
Right.
because it has to, we're trying to get the top 50% capitalization of every sector.
Understood. So could we potentially run into a Nortel issue here, where I remember at the peak in 2000, I think Nortel was pretty close to 35% of the TSX.
37%. Yeah, so you wouldn't get it in the ESG leaders unless you had it in the parent index.
Right.
So if you had something an outlier in the MSCI Canada index, that could be reflected if it had the same ESG score in the ESG leaders index, but otherwise no.
Okay. All right. Well, good to know. So in the last couple minutes here before we get into the question and answer session, can you share with us what BMO has to offer in this area?
So we've the one I would point people to first and foremost is ZESG, because it's a global balanced stock and bond portfolio, which covers Canada, US international, and fixed income as well. So it's very, very easy to implement into a portfolio. The other ones, the equity ones, so ESGA for Canada, Y for the United States, and you can see the others. Those are pure equity plays for regional exposures. We've got the ESGB and ESGF. Now, something we really haven't talked about, Larry, is the notion of green bonds. Green bonds are raised capital that are supposed to be used for green initiatives and to generate green revenues. The trouble with green bonds is that they're notoriously illiquid and they trade at a premium. So it's a great idea from a responsible investment perspective. You might be overpaying for your bond, and so that, from an investment perspective, that might not be so attractive. These are ESG bonds, meaning these are bonds issued by companies who have high ESG scores, and so they're as liquid as any other issue, but they're just from companies that have much better ESG rankings than their peers. And the other thing we brought out is the Global Dividend High Covered Calls, ZWG, which uses an ESG benchmark as its selection universe, but then does our proprietary sustainable dividend growers analysis to isolate the companies. And then we've got that that very attractive covered call overlay to generate tax effective income. So it's a way to green your money, but also maintain high income.
Well, I got my green shirt on just for that reason. And so I love the idea of ZWG and to enhance yield and you know, become a good corporate citizen in that regard. So how fast is ESGA AUM growing? So what's been the experience since 2020?
Larry Einstein said, never remember anything you can look up. So I don't remember an individual ticker and how much money it has in it, because I have to remember too many other things. We have over $1.8 billion in our ESG ETFs as a group. We also have Z Clean for clean energy, and we have WOMN for women in leadership. So, but cumulatively, we have over $1.8 billion. We're the largest ETF ESG provider in Canada.
So I've got here on the Bloomberg terminal the market capitalization and total assets
So
in
there you go.
ESGA is 133.
Yeah.
Right, and if we were to look at ESGY,
That'll
the
be
US
big.
version,
Yes, because we have a very large institutional investment.
almost $1 billion there.
And if you were to look at ESGF, which is its hedged version, you'd see another.
Well, it's showing 23 million in there.
Oh,
Bloomberg doesn't
maybe
always have the. Oh, you're talking
Oh, no,
about not yeah. That's the bond. That's the US bond. ESGY F. Yeah, there's another 800 there. So total assets, it has 1.83 between the hedged and the non-hedged. That's what it's showing.
Right.
There. Yeah. Okay. So wow, right? So I think it's growing, and so to answer that question, where can a small investor find ESG ratings? So a couple slides back, I had put up a couple links to the Just rankings and to the S&P Global. Does MSCI have a website, or does the BMO resource tool have a place they can go?
So if you go to BMO ETFs with an S.ca, which is the BMO ETF dashboard, you can actually click on our one of the tabs, and it'll take you to our responsible investing area, and you can click on an MSCI tool that allows you to rank ESG company or see the measurement for the ESG score on a company. And there's another link that can actually link you to a fund as well, so you can see each fund as well. For those of you who look at our ETF roadmap, we actually have Sustainalytics rankings. When our ETFs rank 3, 4, or 5 globes, we show that to you in the corner of each box. So we're pretty transparent to help people take these decisions.
Okay, so a lot of the questions that people had wrote in tonight were not specifically ESG rating. Someone had asked, a year ago or so, I maintained that we were at the end of a business cycle. And so, again, not ESG related, but perhaps, Mark, you could offer an opinion here. But they were saying, so what is the secular bull market? What is the business cycle? So historically, the business cycle is about the expansion and contraction of credit, and it has to do with interest rates and the yield curve and what we're seeing in the different aspects of the yield curve. And I had been talking about in 2019 that the yield curve have inverted. meaning short interest rates had been pushed up above longer interest rates, and that historically meant the end of the business expansion because the central banks were restricting credit, and that would typically cause a recession. And we had one, and it lasted for all of a nanosecond because of the incredible response globally from governments and from central banks, where we have created, I think the number I heard the other day was $17 trillion of new debt, of which the central banks of the world have monetized the vast majority of it by way of quantitative easing and expansion of their balance sheets, i.e. printing money. So that was the end of the business cycle, except what we've learned is that the central banks are going to be so reactive. So now we're at the point now where the Fed has started to talk about pulling back. They're starting to buy less bonds. So they're being less accommodative, and at some point by the middle of next year at the latest, and it could be accelerated, that the Fed will stop buying bonds. There's still a lot of deficits to be financed, and so interest rates probably see a bit of an upward push. And so to the extent that they're raising rates, they start raising rates faster than the bond market sees economic slowing, we get an inversion in the yield curve. I don't see that in yield curve inversion coming until late 23 at the earliest. So I think the central banks will start to raise rates. The last time they went from 0 to 2.5. The time before that, they went from 0 to 5.5. The time before that, on average, historically, they've been raising interest rates 500 basis points at the end of the business cycle to slow things down, to curb that inflation pressure. This time around, if we raised interest rates 5%, the world would shut down. I don't think we'll get to 2.5. In fact, 1.5 Fed funds rate, to me, would invert the yield curve. We would see the 10-year fall below 1.5%, where it is today, basically, and we would see an inverted yield curve. And then what would happen is the economy is going to slow down and the Fed will start cutting rates again. And if it gets bad enough, they'll start doing more QE. So to answer your question, Ron, that historically is the end of the business cycle. But it's a cycle, and it recleanses and starts again. What's gone on now is completely off the charts in terms of anything normal. And the S&P, 39% higher, as you point out there. So good question.
Well, and Larry, if I can just sort of chime in a little bit, there may have been indications of being at the end of the business cycle in January 2020, but once the pandemic hit, all that stimulus pushed that off and money became easier, and that's why you've seen such a surge in the S&P 500. Is that money remains plentiful. You're not getting any money off your bonds, and so people are being encouraged to get returns out of their equities, and that's why you've seen behavioral change, because money's been kept artificially cheap to create stimulus.
Somebody commented on the questions here that I'm not giving enough investment advice, and that he's going to go back to listening to Garth Turner. I feel sorry for you. I also see that he's left the chat tonight already. So some people come onto the chat here to the webinars, and they want to be given on a spoon and have Larry or Mark tell them what to buy tomorrow morning. That's not what this is about. So anybody who's online looking for that spoon and want to become the next Warren Buffett, and I really hate to say this, please don't tune in anymore. That's not what we're trying to do here. We're trying to talk about ideas. We're trying to educate people about investment ideas and themes and trends. It's not about giving you a tip on what stock to buy tomorrow. So please, 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 don't think about it that way. However, if you're looking at what companies that we would say, have a look at these, this graphic that we had put up 5 or 10 minutes ago, and we talked about the double weightings in the ESG. So if you happen to be an investor who wants to participate here, what names do you look at? Well, you can go buy the ESG ETF that BMO manages for Canada. You can buy the iShare version or the Invesco version. There are several competitors out there. It's not a commercial for BMO. I want to be very, very clear on that. But if you're looking at individual companies as to which ones do you buy today, here is the list of some of the top ones. And BMO happens to be there. It's interesting that Bank of Nova Scotia has a higher weighting. Now, the reason it does is not because it's a better bank in terms of ESG, right, Mark? It actually is a bigger company by market cap.
It's got a larger market capitalization, and so Larry, this is a great example of can you get distortions in the ESG index? And here you can see the only reason it's got higher exposure is because its capitalization footprint is actually higher in the Canadian economy.
Yeah, no, exactly here. So again, I understand the person has left, and I'm really sorry that I can't please 100% of people, but for those of you who did comment and say you enjoy what we're doing here, I thank you very much for participating, but it is unfortunate.
Larry, people like us are always asked for our insight, and that insight people often want is a recommendation, and it's irresponsible for us to make recommendations because we don't know people's individual circumstances.
Well, that's it. That's the exact case. I mean, we had an example a few years ago, and speaking of ESG and energy, woman calls in asking if she should buy the leveraged natural gas Horizons ETF, HNU, triple leverage, double leverage, whatever it was. And I was trying to explain to her in 30 seconds why she shouldn't do that, and it wasn't enough time. So I said, give me a call in my office. And she did. And I actually got Howard Atkinson on the show, who was the president of Horizons ETF a few weeks later. Did a whole half-hour segment on what happens with leverage ETFs. Spent almost an hour with this woman trying to educate her about what was it that she was buying. And after all that effort, she said, so Larry, should I buy more? And this woman, 68 years old, had an $800,000 portfolio and had already committed 50% of her retirement portfolio to this ETF that was already down 50, 60% from where she bought it from. And she wanted to know if she should buy more. And my effort was to try to educate her on not to buy more, not to average down, not to want to get your money back, but how to think about what she was doing and that it was catastrophic to her retirement. And to me, that's invaluable, not the stock pick, because as you point out, Mark, and you're very right to say this, we don't know who's on the other end of that. I don't know who Nelson is or who Greg is or who Linda is. And maybe I've met them at live events before, but the names maybe don't stick. And so anyways, I think we're almost out of time tonight. So we've got about a minute left. If you've enjoyed what we do here, please, please, please consider supporting one of our charities. Again, Alzheimer's research at the Baycrest Hospital and Foundation here in Canada, in Toronto, and the Hospital for Sick Children, both world-class leaders in what they do. And a special thanks to BMO, because one of the biggest supporters that we have corporately is our relationship with BMO. And I'm very, very pleased to say BMO has donated, just stepped up and made an incredible donation this year to that charity. And so thank you, Mark, and thanks to all the people for BMO for what you do here, for what you do for investors, and for what you do for investor education. Thanks for being here tonight, and thanks everyone for joining us.
Thank you.
Have a great week, everyone.